AGNC Investment Corporation is what's known as a real estate investment trust, or REIT for short. These companies play a unique role in the financial world, acting as a bridge between real estate and everyday investors. In simple terms, AGNC invests primarily in mortgages, which are the loans people use to buy homes. Instead of owning physical properties, they own the rights to the payments homeowners make on their mortgages. What sets AGNC apart is that they focus on mortgages that are backed by the US government, which adds a layer of security to their investments. These are often issued or guaranteed by well-known government-sponsored entities like Fannie Mae and Freddie Mac, which helps reduce the risk of default. AGNC purchases these mortgage-backed securities and in return, collects the interest payments that homeowners make each month. The income AGNC earns from these interest payments is then distributed to shareholders in the form of regular dividends, making it a popular choice for income-focused investors. This business model is, honestly, pretty attractive to a lot of investors who are looking for steady cash flow and exposure to the real estate market without actually owning property. One of the main draws is the potential for high dividends, which can be much higher than what you'd get from traditional stocks or bonds. That's because, by law, REITs like AGNC are required to pay out at least 90% of their taxable income as dividends to shareholders, ensuring a steady stream of payouts. However, it's important to remember that investing in AGNC isn't without its risks. Factors like interest rate changes and economic downturns can impact their earnings. So, before investing, make sure you understand how these risks could affect your returns, and whether this type of investment fits your financial goals. AGNC is known for its high dividend yield. As of April 2025, it's around 15%, so, for every $100 invested, you could receive $15 in dividends each year. Sounds great, right? But, there's a catch. This high yield is mainly due to AGNC's falling stock price. When a company's stock price falls, its dividend yield goes up, because the dividend payment is a larger percentage of the lower stock price. So, while the high yield might seem tempting, it's crucial to understand why it's so high. It's not necessarily because AGNC is doing incredibly well. AGNC's stock price has been on a steady downward trend, catching the attention of both new and long-term investors. Over the past several years, the company's share value has faced significant pressure, reflecting broader challenges in the mortgage REIT sector. Since its IPO, AGNC's stock is down about 50%, which is a substantial drop for any company. This long-term decline has raised questions about the sustainability of its business model and future prospects. That decline is a major concern for a lot of investors, especially those who rely on AGNC for steady income or have held shares for years. Many are now reevaluating their positions. There are a few reasons for this drop, and understanding them is key to making informed decisions about the stock. One of the biggest factors is the fear of rising interest rates, which has been a persistent theme in the market lately. When interest rates go up, the value of existing mortgages falls because new mortgages offer higher returns, making older ones less attractive. This isn't great for AGNC, since they hold a large portfolio of mortgages that lose value as rates rise, directly impacting their balance sheet. As the value of these assets goes down, so does the overall value of AGNC's holdings, putting further pressure on the stock price and investor confidence. Another reason is AGNC's high payout ratio, which means they distribute most of their earnings as dividends. While this is attractive for income-focused investors, it leaves less money for reinvestment and future growth, making it harder for AGNC to adapt to changing market conditions or recover from downturns. Investing in AGNC definitely comes with risks, and it's important to understand them before making any decisions. AGNC is a mortgage REIT, which means it operates in a sector that can be quite volatile, especially when market conditions change rapidly. One big risk is dividend cuts. AGNC is known for its high dividend yield, but that payout isn't guaranteed and can be reduced if the company's financial situation changes. If AGNC's earnings go down, they might have to cut their dividend, which can be disappointing for investors who count on that steady income stream. That would be a significant blow to investors who rely on that income, especially retirees or those seeking regular cash flow from their investments. Another risk is the potential for the stock price to fall even further. AGNC's share price can be sensitive to changes in the broader economy and investor sentiment. If interest rates keep rising, AGNC's stock price could drop more, leading to big losses for investors. Higher rates can also increase borrowing costs and reduce profit margins. It's also important to consider AGNC's high leverage. The company borrows a lot to invest in mortgage-backed securities, which can magnify both gains and losses. They borrow a lot of money to invest in mortgages, making them more vulnerable to market swings and interest rate changes. While this can amplify returns in good times, it also amplifies losses when things go south, so the stakes are higher for investors. So who should actually invest in AGNC? It's not a one-size-fits-all investment, and it's crucial to match it with your own risk tolerance and financial goals. Well, it might be suitable for long-term investors who are seeking high total returns and are comfortable with some ups and downs along the way. By reinvesting dividends, they can potentially benefit from compounding, which can help grow their investment over time despite short-term volatility. Still, AGNC isn't right for everyone. The risks can outweigh the rewards for some, especially if you're not prepared for price swings or dividend changes. Investors who want stable income or those with a low risk tolerance should probably steer clear and look for safer alternatives that better fit their needs.